Marin Katusa's new book, The Colder War, is now on bookshelves. Marin pulls away the curtain on how Russia, China, and Iran have come to dominate the global energy stage and put the petrodollar to rest once and for all. Find out why Dr. Ron Paul and critics alike are calling The Colder War one of the most important books you will read this year. Visit PalisadeRadio.com and enter our weekly drawing to win a free signed copy of Marin's book. That's PalisadeRadio.com.
This is Collin Kettell with Palisade Radio. The winner of this week's book giveaway is Johan from Canada. Congratulations to Johan. And we've had a ton of sign-ups over the past few weeks for this book giveaway, so be sure to go to PalisadeRadio.com and sign up. There's 3 books left to be given away. Now this week we're doing a special edition of Palisade Radio, and we're going to identify some of the major themes for 2015. I'm down in the Bahamas right now with my good friend David Skarica. David's been on the show before and is the publisher of Addicted to Profits. David, welcome back to the program.
Thanks for having me.
You know, over the past couple days, we've discussed what you've called the 4 major themes that you've identified for 2015. And these are actionable trading ideas, with 2 of them being on the long side and the other 2 being on the short side. So let's just get started with the 2 ideas you have on the long side. And the first one is Russia. You know, the ruble right now is in a free fall. The government has just hiked rates to 17%, and the economy is largely based off oil and gas and commodities. You see a great way for investors to make money once the bottom's in here.
Yeah, one thing I always look for is kind of panics and crashes, and what my mentor John Templeton would call maximum pessimism. And he actually had some very famous trades where, you look what's happening in Russia now, very similar to, say, like South Korea in 97, 98 when they had a currency crisis and their stock market crash, or even Russia itself in 98 when they had a currency crash. And what you look for is just basically out-and-out panic. The currency's in free fall. The stock market in our currency terms is in free fall. And these are the kind of things that you look for. And then, of course, the valuations get to ridiculously cheap levels, like on the Cape, which is the Case-Shiller 10-year, average PDE ratio. You've got Russia trading, at something like 2 or 3 times earnings right now. So it's easily the cheapest market in the world. And of course, it's cheap for a reason, because you have sanctions, you have a slowing economy, you have like you said, a petrol-based economy with oil and gas falling. So you have these reasons why it's falling, but it's also really, really overshot to the downside. So it's always difficult to catch the falling knife and find the bottom. So I like to kind of average in. But when the ruble dropped 20% the other day, and most of the Russian ADRs were down between 10 and 15%. And I actually did a little clip on my computer of the Bloomberg front page. And there were about 20 articles on Russia there, all talking about Russia being in free fall. That's the kind of perverse, extreme, sentiment I like to see at a bottom. So I actually began to really start buying Russian stocks. And I guess that would have been Tuesday of this past week.
And your theme's always maximum pessimism. And you look at Argentina and Venezuela. Talk a little bit more about how when times get tough in a country, all the money floods into the stock market. That could very, very well happen in Russia.
Yeah, if you look at countries that go through hyperinflations and massive currency devaluations. Now, Argentina and Venezuela are a little unique because they have currency controls. So the one way that people can get their money outside of just owning the currency, which is devaluing, is to own stocks and bonds, or especially stocks, because stocks have, you own a company that has sales, that has assets, has businesses, etc. So that's a way of kind of diversifying out of the free-falling currency, especially if you can't, say, just go buy US dollars or the whatnot, or get your money out of the country. So this is going to be a great way for Russians to kind of protect themselves against the free-falling ruble. And if you look at some of the companies in ruble terms, like Lukoil, which trades under LUKOY in the States, but in the ruble terms, Lukoil's been going up ever since October, even with oil crashing, because oil in Russian terms has gone up, and because the ruble's gone down. And Lukoil is a fantastic company, pays a big dividend, and that's, again, a way to kind of diversify out of a free-falling ruble. So it's really just a way to play against a currency devaluation. And it's easy to say, gold in ruble terms has gone way higher, just buy gold. But buying stocks is a little more liquid than, say, buying precious metals sometimes, especially physical. So that's a way that the rich or even middle class will diversify out of a free-falling currency. And usually the history of hyperinflations is that won't keep up with the hyperinflation. But it will, like say you have 1,000% inflation, the stock market might go up 800%. So it's much better than just owning the currency itself. It's a good way to protect yourself against a hyperinflation.
Okay, and the next theme is the precious metal space. It's something we talk about a lot on Palisade Radio, and the same in your newsletter. Some people sound like broken records. We've been calling for the precious metals to go up. 2013, 2014, both those years were pretty bad. Things might be turning around now, but all the indicators, all the contrarian indicators are saying that we're getting very, very close.
One of the key things I watch in gold is a very simple ratio, which is the HUI to gold or the GDX to gold. Like just basically comparing the price of the gold stocks to the price of the metal. And the HUI to gold ratio is back at the 2000 lows, even cheaper than the 2008 panic bottom. So we have gold stocks compared to gold as cheap as they have been. And despite all the negative sentiment in gold, if gold finishes over 1180, it will actually be up this year, right? And let's say gold could have a little rally and finish at 1225, end up, 6 or 7%, actually up almost as much as the Dow is this year.
Yeah, that's something nobody's even considered right now.
Yeah, and then when you consider that going back to 2001, gold has essentially been up 13 of the last 14 years. It's like it's really just had one poor year last year. But I think the problem with the stocks is, number one, from what I've been researching, there's a big hedge fund trade on where they are long the equity markets and short the precious metal stock. So even though gold's not collapsing, they can kind of use their algo trades to make that trade work. And then of course these precious metal stocks need higher precious metal prices to be profitable. So if gold just sits at 1,200, that's not really great for these precious metal stocks, and they'll erode kind of slowly. They won't collapse because gold is 1,200. The price isn't collapsing, but they need higher prices to really be profitable. So they'll probably continue to underperform if gold sat here at 1,200. But of course, they're much more leveraged if gold moves higher. So I really like them because, again, just on a basic fundamental standpoint, you look at like the price to book or price to sales, of these gold and precious metal companies, they are like almost at historical lows. So I really like them as trades here. And actually long-term investments, this could end up being like buying the gold stocks in 2000 or 2008, where the next 3 years is absolutely fantastic with huge triple-digit, if not quadruple-digit type returns.
And before the interview, David, we were talking about some of the best ways to play these gold stocks because, let's face it, they're all down, 60, 70, 90, 95%. And there's ways to actually identify companies in this market that even if the gold price drops a little bit more, they're insulated, they're so cheap. One of them that we both identified separately is called Galani Gold. And it's headed by a guy named Ravi Sud. He's just done a great job. They took over a mine from Gold in 2008. The cost of production was $1,400 an ounce, and they're now down to $900 an ounce in their last financials. And marginal gold producers talk about that. Why is marginal gold producer the way to go?
Because, like you said, if you can control your cost of production, your margins will be higher when gold turns around. And then number two, because you have a smaller amount of production, just basic math, like, what does Barrick have to do to increase their production by 5%, right? What does Galani have to do to double their production, just from 50 to 100,000 ounces a year? So I'm not going to say that's easy, but it's much more attainable, right?
Right.
And the big guys are actually getting smaller right now and just trying to get more lean. Where a guy or something like Galani, again, can expand production, expand margins when gold goes higher. And so, and a lot of these smaller gold, obviously that properties have to have proper geology, but they have to have proper management and proper team in place. Like I was telling you about back in 2009, there was a company I looked at called Avion. And Avion, very similar kind of story, took over a property from Nevsun, which wasn't properly drilled, was a high-cost property, restructured the whole thing, began production again in 2009, perfect timing with the bottom of the gold market, and Avion went from being a 6-cent stock to being ultimately went to $2, and then was taken out at roughly just over $1 or under $1. And the only reason it was $1 is because it was in Mali, and there happened to be a coup in Mali, which made some of the stocks kind of sell off in that region. But that's just an example of what can happen, is that you have a marginal gold producer, they get their costs under control, they expand production, they're hyper leveraged to an increase in the cost of gold. They don't have all these shares outstanding, they don't have all this overhead of stock, especially when it's like a new deal like Galani. And then they can just kind of really, really take off and rock it. So actually what I'm doing right now in the gold sector, as we mentioned earlier, is buying stocks like this, buying smaller producers, and maybe just buying some of the leveraged ETFs. And I really don't have really much interest in the large cap gold stocks. I want to buy the marginal producers, and my exposure to the large caps can be buying GDX or something, right? But that's what I want. The marginal producers are where you get the multi kind of bagger potential if gold goes up and if these guys get their get their production increased, etc.
Yeah, and that's why we were saying before, the market's so cheap. Like, Galani Gold has $12 million in cash, and their market cap's like $8 million. And they're producing 50,000 ounces a year at a profit. It's not going to get any cheaper than that.
And again, that's also what I'm looking for, is that after looking at how cheap stuff got in 2000, 2008, and I've been in the gold market since about, I would say 97, 98, after seeing how cheap some stuff got, I knew that in the next bear market, whenever it happened, we'd get stocks trading at under their cash value. And Galani is just one of those.
Let's move on to the short side now, and the trade that you brought to my attention, I didn't really buy it at first until you went more in depth, and it's pretty amazing. As oil and gas prices have come down, the American consumer thinks that that's a great thing. They're going to be able to fill their car up for cheaper, but a lot of money, easy money, was going into the fracking companies in Texas and North Dakota. There was almost a bit of a bubble created there. Nobody saw the oil and gas prices coming down. But most people haven't thought about the money, the junk bonds that went into the oil and gas sector. Talk about that.
Well, if you look at the HYG or the GNK, those are the junk bond ETFs, they have really kind of eroded badly outside of the little bounce of the last couple of days. And that's because roughly 16% of the junk bond sector, nearly $200 billion worth, is gone into energy, and mostly the shale oil companies. And as we know, for the financial crisis, the question also too is who owns it and how was this stuff packaged? Is it leveraged 10 or 20 to 1 in some, scheme, right? So there's going to be massive defaults in that sector, and it will affect the whole junk bond sector because historically energy is about 5%. So now you've got it at 16% because of the huge boom there. And then, so I'm looking at a way to play it, and I see, like, if you bought like protection against or even bought put options on the shale oil companies, I really don't like that now because they've already tanked. Like, a lot of them are down 80, 90%. Even the higher tier ones are down 60, 70%. So what I've looked at now is I found 3 banks in the Midwestern United States. And if you read about the oil bust in the mid-'80s, you'll see it wasn't just like a bunch of oil and gas companies went bust. The banks that loaned those companies, that loaned the consumers money, they all went bust. Businesses around there went bust. So these 3 banks I'm looking at have north of 10% of their loans to direct to shale oil companies. Well, that means what percent of their loans are loaned out to the people who work for their companies in forms of mortgages, credit cards, and then they have loans to, say, small businesses or businesses that serve people in that industry. So if you start seeing defaults or failures in the shale oil gas space, these banks could just absolutely implode. So I have a simple option play. I'm going to start probably in the new year, where we're going to buy put options probably 3 months out of the money, roughly 5% out of the money, and just roll them over every 3 months. And then if you just get a small decline, like these stocks, by the way, decline 10, 15% when oil prices tanked. And if you just get a small decline, you'll make money in the puts. And if, like, at some point you get a 2008 type of implosion in these specific banks, and they almost go into single digits, and most of these, by the way, are $60, $70 companies, these puts will go up thousands and thousands of percent. So I like basically playing a leverage play that is loan money to individuals and businesses in the sector that's imploding. Because remember, it's going to take a while for that to filter, right, down the line. And we haven't even seen the layoffs start. I think shale oil, because it's the first bust, in the oil sands in Canada, we've seen layoffs start because they've been through a few of these cycles. And shale oil, I think they're kind of delusional. They don't know what to do. They're kind of in paralysis. So when I think these low oil prices between, say, 55 and 65 are going to stick here for a 3 to 6 month period at least. And when that happens, I think that's when the layoffs start, and then you get that trickle-down effect kind of happening from that.
What you're touching on is a lot of people think the oil drop and whatever effects it's having on the economy are over at this point, and it's kind of just starting. You know, for example, some of the things that happened back in 2008 took a couple months to really crash the market. What's your thoughts on if this could be some type of a black swan event that deflates the equities a bit?
Yeah, I think like either later next year or into 2016, that's the event. Actually, the next one we're going to talk about is Japan as well. Could be the other one, but this is really the major U.S. based event that it's not so much just like whatever, there's 16% of the junk bond market. But if you then get a bunch of bank failures and then the rest of the junk bond market, which the yields are coming up on now, freezes, and then that goes into the corporate bond market. And most of the buying in the stock market right now is in like these companies buying back their own stock. So if all of a sudden IBM or Caterpillar don't have access to corporate loans, and then can't use their full cash flow to buy back stock and then replace the cash on the balance sheet with loans, kind of like almost like a Ponzi scheme at this point, then all of a sudden they can't buy back stocks. That puts a huge buffer that's under the market, takes it away, and the market can just kind of go into free fall. So I think that this junk bond bust in oil and gas is definitely kind of a black swan event that could trigger the rest of the market. If you remember in the 87 crash, junk bond market blowing up was one of the triggers for the crash. And a lot of that was due to in 86, 87, the junk bond market in oil and gas blew up because oil went under $10 a barrel for a while. So I think this could definitely trigger a severe downturn. And the last thing I'm going to say about it is you can't have it both ways. When oil was high at 100 and the shale boom was going on, all I read about was the U.S. is going to surpass Saudi Arabia. We're going to be the biggest oil producer in the world. But now when we go down, people are saying, oh, it's great for consumers. So it's either, you can't be either an oil consumer or an oil producer. You kind of have to be like one or the other.
Yeah, you can't have it both ways.
And I think the U.S. is going to find out the hard way that they've become more of an oil producer that has more, the high oil price actually was helping the U.S. economy than a low oil price will. And I just think that's going to take a while to filter, but that's what's going to happen.
All right, so we'll see how that plays out next year. Finally, let's talk about Japan. And this is a trade that I've been running for about a year now. Japan's 10-year bond yield is at 0.36% today. And just to give listeners an idea, the United States 10-year bond yield is about 2.25%. Japan's in much worse financial straits. They're printing a lot more money. It's almost hard to believe how the bond yield is that low. There's really no answer. I mean, the government's buying most of the bonds. First of all, let's talk about the problems with Japan and why there could be a crisis in the bonds.
Well, a lot of the problems in Japan, and Kyle Bass talks about this, are structural, where they have a very xenophobic population. They have a declining birth rate, declining population, huge social welfare state, but they won't allow immigration to replace the fact that they're not making enough of kind of like their own children. So that leads to structural problems because they can't basically afford the pension system that they have, right? One reason that they're allowing the largest pension plan to invest outside the country is because even if the yen implodes, then you get more yen for whatever you're invested in, euros, dollars, whatever outside the country, and they can keep kind of their own pensions solvent basically by diversifying the pension plan outside the country. But anyhow, to get back, structurally, that's their problem. And then they're just trying to print their own money and print their way out of this rather than, really, really, really dealing with their own problems, right? So and they're devaluing their currency like crazy. And then on the inflation side, Japan has no natural resources. There's no shale oil boom in Japan. They have to import all the resources. So when they devalue the currency, they create inflation. And when Kuroda, the Japan central bank minister, when he talks about, we want 2% inflation, real inflation is probably already at 4 or 5% in Japan because of the devaluation of the currency. But they're again using one of these central bank measures of deflation that deflates what inflation really is. And, really, you got 5% deflation in the real economy, and the 10-year bond is 0.36%. This is the biggest kind of scam going. This is like going to be the biggest disaster in the world when it finally implodes. But the question is, when will it implode? Because they're printing the equivalent of the U.S. printing $3 trillion a year. They're basically monetizing their entire debt. So the question will be, when does the market happen? Like we were talking off air that basically, if only 2% of the bond market trading every day revolted and dumped, that would be enough to send the bond market into a downward spiral. So When does that happen? Or do they just say, get all the debt on the central bank's books, then default on that, and that would still send rates spiking for the rest of the curve?
My buddy Trey Knippa runs a fund, and the good thing about why this trade is so easy to do is there's no volatility right now in the bond yield. It's been stuck between 0.65% and 0.36% for over a year, whereas like the oil and gas we were just talking about, you have to look towards the banks or something unique to run the trade. So, you know, he says a lot of people think that the bond's not going to blow up, the government's going to keep buying it, but what they don't realize is as they inflate the yen away more and more, your negative rates become so bad that at some point people are going to dump, and it's just going to go overnight, you know, to 5-10%.
Yeah, and that's what happens in these crises. Like I was mentioning to Collin off air, if you go look at the bond yields of all the PIG countries in Europe, they all went down with all global bond yields in 2008, 2009, and then they had a disconnect when it was obvious that their financial systems and their economies are really eroding badly, much worse than the global economy in 2010, 2011. And what you'll see is like you have this slow downward slope in yields, and then it's just this complete straight up spike for like 6 to 12 months. So that's what's going to happen in Japan. It's not going to be like this slow base building. It's going to be whatever. It might go to 0.3%. And then all of a sudden, next thing you're going to see is a month or 2 months later, the Japanese bond is going to be 1% or 2 or 3%. And the country is going to essentially be insolvent. And like you said, I'm going to do it as well. Trey has this very unique way of playing, you know, a potential meltdown in the Japanese bond using like shorter term options and that sort of thing. And it's kind of limits risk with also huge upside opportunity. It's kind of one of those things like it's like an insurance collection. Like if it pays off, it's just gigantic. It's totally worth doing, you know?
Yeah, absolutely. Well, on that note, let's end this discussion because we could go on forever. David, thanks so much for coming back on the program, and hopefully some of these trades work out in 2015.
Yeah, thanks for having me.
Vladimir Putin is a self-made man. He did not come from money. He did not come from a royal family. He was your blue-collar boy who did well. Putin has positioned himself in the center of the chessboard in the energy matrix of the world. Right now, Putin and his allies in China, India, Brazil, all of the emerging markets are aligning together to fight the European Union, the IMF, and America. Eventually, the rest of the world will realize that Obama and America are hiding behind this curtain with no powers anymore. Putin specifically has positioned Russia to become a global superpower, and America has never been more vulnerable than it is today.